Hey out there, thanks for tuning in. So today I want to talk about something that I enjoy talking about. However, I don't talk about it in big circles that much because it could be called controversial. I'm not going to say any of these things I'm going to talk about are illegal. Probably not even fraudulent. I don't think so. But they are pushing the envelope. They're getting creative. And what I'm talking about is improving your chances of getting financing, whether it's for a house that you want to go in and buy and live or an investment property. Some of these techniques or strategies could really be worth it. But before I do, I have a little disclaimer. It's for mature audiences only. And I also want to say this. None of these things I'm going to go over are things that I'm suggesting that you do or I'm advocating for. These are none of the things I've ever done. I've never done these, but I've heard about these things. So I want to share them with you in case you come across a situation. Who knows? It could really benefit you, or you may choose not to do them. So that leads me into my first thing: honesty versus brutal honesty. What do I mean by that? Here, I'll give you an example. Let's say you're going for a home loan, and in the employment section, you fill out where you work, the name of the company, the address, how long you've been there. That's honest. Now here's brutal honesty. You know that the company's going to be downsizing in 9 months or a year or 2 years. You don't know where you're going to be going. You might even have another job lined up. I don't know. But do you want to write that in the box under employment? By the way, Mr. Underwriter. No. That's brutal honesty. They don't need to know that. So, it's all an individual comfort level that you come up with. And again, I'm not advocating any of these. I'm just telling a story. It's for entertainment reasons only. Let's say you have some dings on your credit. Let's say you got a repossessed car from 7 years ago, right? And it's showing up on your credit. Well, I've heard of people disputing that on their credit report by writing, because there's 3 bureaus. And if it's on all 3 bureaus, then you're going to have to do this. It's going to require a little bit of work. But you're going to write to all 3 bureaus and you're going to dispute it. And I've seen people simply say this: it's not my account. Wasn't my car. It's wrong. And sometimes I think it was their car. And they still said that. Well, guess what? Most of the time, depending on the age of the debt, it will just go away. The reason why it'll go away is because the creditor doesn't have the time or the resources to look into every dispute. So a lot of times it just goes away. Now you could pay a credit repair company to help you in this, and you won't have to do all the legwork. But I'm saying it's really not that difficult. You get it done for free. So there's one technique. If you get your credit report, or what I've heard people do, is they simply dispute it and they send it back without even thinking, and every negative thing that's on the credit report, they just say it's not mine. And heck, if 50, 75% of the disputed stuff comes off without you even having to provide any documentation or something, credit score goes up, you're already ahead of the game. Let's talk about owner-occupied versus non-owner-occupied. If you go in for an owner-occupied loan, you intend to occupy the premises as your primary residence. You go into a non-owner-occupied home, it would be an investment property. I don't know how they consider second homes. I would imagine that would be a whole classification in itself. As a matter of fact, I think it is. The difference between owner-occupied and non-owner-occupied is they're stricter with non-owner-occupied as far as how much of a down payment, the interest rates aren't as good. There's a couple other features of the loan that's not as favorable as if you were going to live in the house. I got intend here because there's going to be a form when you're going for a home loan, and it's going to say, do you intend to occupy the premises as your primary residence? Now, I don't know the exact definition of intend, but I've heard that intend means, well, I mean to live in the house. However, if you sign that form and then something happens where, I don't know, if you're selling your house, or you really like the apartment that you're in and maybe you want to stay there. I don't know the reasoning that goes behind changing your mind from the time you fill out your application till the time you actually close on the house. But things do come up. And I think that's why the wording in there is so specific. Intend. It doesn't say must. It doesn't say any of these things. So that's another way that I've seen people get creative. Funds available. Now when you go, especially first-time home buyers or younger people that maybe have family or friends that they're just leaving their residence and they're going out on their own and they're buying a place, and when funds available comes up on the application or in the mortgage process, sometimes we run into problems where, let's say you need $10,000 to show between down payment and closing costs and stuff, and the young person has, let's just say $5,000, and they have a family member, let's just say a father or a friend or somebody that has a bank account, a different bank account. Well, what I've heard people do, I'm not advocating, but what I've heard people do is put the borrower who's going for the mortgage onto their bank account. So what they do is they go to the bank, they say, you know what, I want to add my son, Joe Blow, to my account right now. The bank puts that person on the account, so now you've got John Blow and you got Joe Blow on there. Now you say, well, yeah, but Harry, when the bank goes to source these funds that are needed, they're going to see that Joe Blow just got on to the bank account. They're not going to take that bank account. But wait, what I've heard, and again, I have not seen this firsthand, and I'm not swearing by this, but what I've heard is that then those same people that did that got creative, would get 3 months worth of bank statements from that bank while they're there, and the bank stamps them. That means they're legit. Now you have 3 months worth of bank statements with Joe and John on it together. All of a sudden the funds available have increased. Now don't get me wrong, Joe is going to have to come up with those extra funds one way or the other, and John, who put them on there, is going to have to trust him that he's not going to go into the bank and take money out. There's a bunch of ways that people could safeguard that from happening. Anyway, you get my point. Income. Now listen, I'm not going to say much about income because I have an experience with income where when I was doing mortgages in Florida, I went to go show up at the office the one day and it was getting raided. I want to say even ATF, FBI, somebody else was in there taking all the files, everything else. Nothing happened to me because I was all legal. However, I've heard of some real illegal, fraudulent activity. Like, here's one. Somebody cut and paste credit reports. And they took out bad credit and put in good, sent it right to underwriting. So when I complain about all the documentation that's needed for today's mortgages, they're really protecting themselves from a lot of bad behavior. So, again, I'm not advocating that you guys do any of this. I am just telling you a story of what I've heard, the risk versus the reward. So let's say you're able to get into a house that maybe you intend to occupy, but maybe in the back of your head you think, this would make a great investment. The risk versus reward going for owner-occupied versus non-owner-occupied, like if you have a VA eligibility, 0 money down, you can't do that in a non-owner-occupied. You can't use a VA loan for an investment property. Owner-occupied, FHA, you can't do that with a non-owner occupied, so you can come up with like 3% down. Or even how about 5% down for conventional versus at least 20% down. How about getting an interest rate? Today's interest rates below 3% for an owner-occupied loan versus, 5 or 6% for a non-owner occupied with 20% down. The risk versus the reward, you make up your mind whether or not that's worth it. And I'm not selling you one way or the other. What's the consequences? What's the consequence if you fill out this, I intend to occupy the premises as my primary residence, and then you really don't live in the house? What's the consequences? What could happen? Well, first, let me tell you how, I've actually never seen anybody get caught. So that's one. The way that I know that someone would get caught and there would be a consequence is if there's late payments on the mortgage. If there's late payments on the mortgage, depending on the deal, they could really press it and they could come out and really jam it home. Now, as far as what could happen, I'm not really sure. So again, I hope you enjoyed this. This was for entertainment reasons only, entertainment purposes. I'm not advocating any of these, but I am just sending out a message of what I've seen done. Just a quick update. I'm personally refinancing my house now, and the interest rates are below 2.5%. Now, we're not sure how long we're going to stay in the house. However, with the interest rates this low, it makes sense to refinance, because if in the future we decide to keep this house as a rental, having 2.375% with 0 points, it just makes sense to do it now. So if anybody's out there on the fence about refinancing now or later or whatever, if you take that into consideration, refinance, and then if you want to rent it, you'll make even more money. Till next time.